Welcome to This Explainer, what the rich never tell you about the stock market. You know, if you've ever felt like there's a secret club of wealthy investors out there playing by a totally different set of rules than the rest of us, well, you're absolutely right. Today, we're going to tear down those traditional wealth-building myths to reveal what the financial elite actually do with their money. We're bypassing the noise, completely ignoring the sensational headlines, and looking straight at the real mechanics of wealth creation. Get ready because this might fundamentally change how you view your financial future.
Buy low, sell high. Let's just dive right into this widely taught cliche that supposedly guarantees your success. We hear it constantly, right? It's in literally every intro finance book and plastered across every financial news network. And it sounds incredibly simple, but it implies this constant active hustle, always searching for the absolute bottom, trying to predict the exact peak and frantically jumping in and out of the market.
But is that how the truly wealthy actually do it? We're going to shatter this illusion right now. Because the reality is that the financial elite use the stock market in a fundamentally different and, honestly, a much calmer way. They aren't sitting at their screens sweating over the daily highs and lows. That is a game designed to generate trading fees for brokers, not lasting wealth for you. True wealth building is surprisingly boring.
The real secret here boils down to money compounding, institutional thinking, and time. It's not about chasing the next hot stock or trying to get in on some insider tip. It's about a complete shift in perspective. Stop thinking like a gambler looking for a quick payout, and start thinking like an institution managing generational wealth. Once you understand how these three forces work together, all that chaotic daily market noise suddenly starts making perfect sense.
Look at this mindset shift. It's the exact difference between an amateur chasing hype and a pro focusing on value. The average investor is obsessed with short-term thrills, asking, hey, will this stock double next month? They're buying an exciting story. But wealthy investors, they're asking a totally different question. Will this company be stronger in 10 years? They aren't buying a story, they are buying a business. They completely ignore the monthly static to focus on the long-term horizon.
And to answer that 10-year question, wealthy investors focus entirely on the core gears of a business. We're talking cash flow, competitive advantages, and long-term growth. These are the true engines of value. Does the company generate real cash? Does it have a unique moat that competitors can't easily cross? Is the industry actually growing? Here's a hard truth. By the time a stock is blowing up in the news and your friends are all talking about it, the smart money is already taking profits. They bought in years ago because they were looking at these solid, boring fundamentals.
This brings us to the ultimate secret weapon, time. On one side, you have the exhausting, stressful task of trying to perfectly predict market crashes, which is nearly impossible to do consistently. On the other side, you have the strategy of just holding quality assets long-term. While average investors spend years sitting in cash, paralyzed by fear of some impending doom they read about online, the wealthy prioritize their time in the market. They know missing the market's best days because you tried to time a drop is way more damaging than just sitting through the drop itself.
10%. Let's talk about the sheer mathematical power of compounding, using 10% as a historical average annual return for broad market indexes. Someone consistently earning that 10% doesn't just double their money in a straight line. Compounding multiplies it exponentially. It's literally like a snowball rolling down a hill. Your money makes money, and then that new money starts making its own money. The snowball gathers mass and speed in a way that's hard for the human brain to fully grasp until you see it stretched out.
Let's look at these decades of wealth building. Year 1, you acquire the asset. Not much seems to be happening. Even by year 10, the growth is pretty modest. But look at year 20. The compounding noticeably accelerates. And by year 30, boom, you are seeing exponential wealth creation. The stock market heavily rewards patience over pure intelligence. Doing absolutely nothing but holding quality assets over decades lets that snowball do all the heavy lifting for you.
But let's face it, maintaining that discipline is tough, because most investors panic over falling prices. It is completely natural, biologically even, to feel pure fear when you see red arrows everywhere. The news is screaming about a recession, and your portfolio drops 20% in a week. The instinct is to sell, to stop the bleeding, to just run away. That's the immature reaction. Let's see how the pros handle that exact same panic.
What quality assets can I buy at a discount? When things plunge, the rich don't freeze and ask why the market is falling. Instead, they ask this question. They actually welcome the volatility. They don't see a market crash as a disaster. They see a rare, massive clearance sale on the very best companies in the world. They understand that human emotion drives prices way below what a business is actually worth.
And to take full advantage of that clearance sale, they use something most people just view as a safety net: cash reserves. The wealthy view cash as a strategic weapon. Instead of nervously investing every single dollar right away, they keep dry powder on hand. It gives them ultimate flexibility. So when average investors are forced to sell in a panic just to raise cash, the wealthy are right there on the other side of the trade, deploying that cash weapon to scoop up premium assets at bargain basement prices.
This dynamic reveals a pretty brutal truth. The market is essentially a machine that transfers money from the impatient directly into the pockets of the patient. Impatient investors are out there jumping trends, buying high on hype, selling low on a panic, and just bleeding capital through transaction costs and taxes. Contrast that with patient investors. They're doing very little, letting strong businesses grow and minimizing taxes. Often doing absolutely nothing is literally the most profitable move you can make.
True wealth means true ownership. If you want to be that patient investor, you need a fundamental shift in your mindset. Average folks work for money, right? We trade our time for a paycheck. But true investors own assets that do the working for them. You're no longer the one generating the value, the asset is. This is the bridge you have to cross to truly understand how the financial elite operate.
Think about it. When you own shares in a great company, you aren't just holding a piece of digital paper that wiggles up and down in price. You're an owner. You own a piece of their future profits, every product sold, every single customer gained, every new innovation. The rich focus entirely on this concept of ownership, knowing that thousands of brilliant employees at these companies are essentially working to increase the value of their shares without the investor lifting a single finger.
Now, consider access to financial news versus the discipline to ignore the noise. Today, information is everywhere. You get the exact same financial alerts on your phone as a Wall Street CEO, but information alone doesn't create wealth. The critical gap is having the discipline to stick to a long-term plan when every alarm bell in your head is screaming at you to panic. That discipline, it's incredibly rare, and it is the ultimate competitive advantage.
So here is the actual blueprint. Buy quality assets, think long-term, stay patient, control your emotions, and let compounding work. It's so simple. Most people know these principles intellectually, but very few actually have the psychological fortitude to stick with them through market crashes, boring sideways markets, and the temptation of overnight fads. That behavioral difference, not intelligence, not insider info, is exactly what determines who becomes wealthy.
Fortunes are built slowly, then appear to happen all at once. As we wrap up this explainer, I really want to leave you with this powerful final thought. That exponential curve of compounding is super deceiving the people on the outside. They just see the sudden, massive wealth at the end of a 30-year timeline and assume it was luck or some secret trick. They don't see the decades of quiet patience, emotional control, and steady ownership that actually built it. So the question you have to ask yourself now is, do you have the emotional discipline and the patience to wait for your sudden wealth? Think about that, and we'll catch you in the next explainer.